So I want to welcome you for attending, and let me start with the acknowledgement, and then I will do my housekeeping. So we recognize that our work at LAS One Investment and the work of our members takes place on traditional Indigenous territories across Ontario. We recognize and respect the history, languages, and cultures of the First Nations, Métis, Inuit, and all Indigenous peoples whose presence continues to enrich our communities. So I will let Keith take over and enjoy.
Thank you very much, Fern. Yes, so we have our manager of our fixed income products for the legal list here, MFS, who's been working with One Investment for, well over 25 years. There's two main portfolios that our legal list investors invest in. These are tailored, of course, to the specific needs of Ontario municipalities. And we guarantee compliance with the requirements in the legal list. So without further ado, I'll introduce Darren Pachter to introduce the rest of the team to give a presentation on the Canadian fixed income markets and our legal list products. Darren, thank you very much for joining us.
Thanks, Keith. And thank you for the time to be here this morning. I hope everyone's been enjoying the weather this fall. For those that I haven't yet met, my name is Darren Patrick, as Keith mentioned, and I'm the leader of MFS's Institutional Relationship Management team in Canada. I'm also responsible for the One Investment relationship in MFS, and to Keith's point, a relationship that we've been enjoying with you for over 27 years. This October, 2 weeks ago, in fact, was our anniversary. So thank you for your continued trust in MFS. I'm joined today by two of my colleagues. You can see their images on the screen today. First, one that's very familiar to folks, Soami Kohly, co-portfolio manager on the One Legal List portfolios and co-portfolio manager on all of our Canadian fixed income strategies in Canada. Soami brings almost 3 decades of experience in the industry and joined MFS in 2009. Also joining Soami is Mike Trudeau. Mike's on the screen as well. Mike sits in our Toronto office as well and works very closely with Soami and the fixed income team as an investment product specialist. And we'll be speaking later on today about how the legal list portfolios have done. As Keith mentioned in the introduction, and as you've seen in your emails leading up to this webinar, we do believe the time is indeed now for fixed income. And that's the theme of today's conversation and what we have tailored our remarks and slides to. We're hoping to engage with you on that. And then there's 3 things that we want to bring out today that we hope you're going to find timely, relevant, and helpful as you go out and engage with your stakeholders in the municipalities. And first, that's what has the impact been of a rapidly changing macroeconomic environment this year. Just by way of reference, the last time that we engaged with you as a group was in April 2023. So a lot has happened since then. We'll talk a little bit about that in the slides that come in the next few minutes. Second, we'll talk more about what we might see next Wednesday from central bank activity, the Bank of Canada meeting, and as well what central bank activity has been like around the world and impacts that's had on the fixed income markets. And finally, as I mentioned earlier, we'll talk about how the legal list portfolios have performed over the last year and how we think they're positioned as we go into 2025. We've had one question so far sent in advance of this presentation. Thank you so much for that. The question was around how do the portfolios, or how would the legal list portfolios behave in different types of markets environments? And we're going to talk about that as we go on today. This is a page you've seen before, but before we jump off, I think it's really important we just reset and show you how we think about managing our clients' assets around the world and how we're focused on managing and delivering value to you, the municipalities, over time. And that's simply at the top of this page by committing our clients' capital responsibly and allocating it over a long time. And we do that 3 ways. I've indicated those on the bottom, but I'll just touch on the 3 points that I think are critical, no matter what kind of mandate we manage for our clients around the world. And that's the first is our team and how we collaborate with one another in terms of our expertise. We'll talk a little bit about our global research platform today and how Soami and Mike engage with those teams around the world. But we have 300 professional investors all over the world that are informing each other, challenging each other, and providing views and diverse backgrounds and skill sets. And in MFS, every voice is valued, and we do take pride in the fact that we are different and we're active and we're thinking ahead on that way. Secondly, we take and have great conviction or belief in the ideas we have in your portfolio over time. We'll talk a lot about that today in terms of performance and positioning around certain sectors. But just by way of an example, as we think about longer term, your corporate bond portfolio, by the way, has delivered almost 0.3% or 30 basis points of annualized excess return over the last 10 years ended September. And then similarly, on the government bond side, the portfolio has delivered 0.46% or 46 basis points of excess return over the same time frame. We'll talk a little bit about why we see that as well. And finally, no matter where we are in the world, no matter, as I said, what strategy we manage, we have a very deep focused approach to risk. And as a bottom-up security selector, that's important because it allows us to know where to take risk in your portfolios and how to pivot, how to change when things do change in the markets, as we have seen that lately. This next page is new, but not new to everyone on this call, because as of March of this year, MFS celebrated our centennial, our 100th anniversary as a firm, a true milestone in our journey and helping clients get to their expectations for their constituents, their stakeholders over time. And we're delighted to have been able to celebrate with clients all over the world, including a large celebration in Toronto, which several of the folks on this call joined us for. And as a firm, it's been entrusted with almost 850 billion Canadian of our clients' assets around the world. We take of our clients' assets all over the world. We take that responsibility that we have with you extremely seriously. So regardless of what kind of plan type you have, what city that you're in, what mandate we're managing, or what length of time we've been working with you, we're here today for one reason only, and that reason is because of you. So thank you again for your continued trust in MFS. I think this is pertinent. I mentioned earlier, we haven't spoke to you since April of 2023, and a lot has changed. On this page, I've captured 9 themes we've seen in the market in Canada. I'm not going to read them all. Certainly, I'm not going to call them out, all of them, but I'm going to draw your attention to 3 of them because I think it's important to set the stage for what clients have been asking us, what clients have been concerned about, and what we have been observing. And the first is geopolitical risk on the bottom left of this screen. Not the least of which is a major election happening in a couple of weeks just south of the border. And the fact that going into this year, over 50% of the world's population was going to the polls this year. Being situated in our Vancouver office, we just had a provincial election where voting took place this week. Elections happening everywhere and around the world and all over the planet. And of course, there's other risks and stresses in the world as well. That impacts how we think, and that impacts what we're chatting with clients about too. The second is artificial intelligence, not new to anyone on this call. I'm sure it's in the middle of this page. We've re-entitled it Asking Intently, and that's not tongue-in-cheek. We think a little bit more about, as we go through periods of rapid technological advancement, as we have seen over the last 100 years, we need to keep thinking longer term with deep fundamental conviction in the ideas that we have for clients. And that's exactly what we are doing. We're asking intently, we're asking deep questions, we're challenging teams on the management of the companies that we own on your behalf. And finally, consistent with the theme of today's discussion, on the bottom center of this page, fixed income and something for everybody. The time is indeed now for fixed income. And with rates going the direction they have been, with the economy changing as it has done since the lockdown restrictions of several years ago, the focus on fixed income has certainly been accentuated. I wanted to put into context before we jump off into a picture of the market in terms of our and as well in terms of the one portfolios. I thought it'd be helpful to just overlay our global capabilities as a fixed income manager, just to remind folks on the call that we do manage about 135 billion of our clients' assets in fixed income mandates, and the platform that we have on this page to engage with clients around that. 3 things that we do for clients, and a few of the folks on this call have been engaging with us over time on more of the consultative aspects and helping clients get to equations they're trying to solve. But we also have risk profiles and portfolios that are dynamic, that help clients get to objectives they need to achieve. And as well, we position portfolios to achieve long-term excess or investment returns consistent with what our clients have asked us and expect from us. And finally, in terms of our journey together, I mentioned earlier, 27 plus years, as of October 1st. This picture and this slide has been in the presentation for several conversations that we've had with you now, but I think it's important just to articulate where we've been since 1997 and how we partnered with you on that journey. And through it all, the focus still has been on one thing, and that has been to deliver and improve outcomes to the municipalities that we've been asked to manage these assets for. Having been through bull and bear markets over this time, having been through rate environments up and down, and then also periods of high and low inflation, I think it's important to provide context or just to understand that we can think through these for you on your behalf. The next 2 pages I won't read. These are summaries of where the legal list portfolios and the prudent portfolios have been over the last, or as of September 30th. Happy to engage with any questions on that. And then finally, we've overlaid, just in terms of a picture, where the legal list portfolios stand from a risk perspective on the bottom horizontal axis and a return perspective on the vertical axis against their indices or benchmarks, just for context. So with that, I'm going to ask Soami to take his mute off and join the conversation on the page, and we'll start with the context of what the markets have looked like this year.
Good morning, everyone. Thanks for having me to come and talk. It's been a while. It's been 18 months. And just to put that in the context of the 18 months, rates, the Bank of Canada was still raising rates at the time versus now where they're going to take rates down. We have a picture of the team slides here. Just quickly, there's been no change in the team or the process, so it's very consistent. What I want to just remind before we go through the presentation, just a couple things about both the corporate bond fund and the government bond fund. They're both very, very high in quality, and they're both liquid bond funds. And a reminder about how we try to add value. We really have 2 things that we try to do to add value over the benchmark. Number 1 is anticipate the direction of interest rates. And when Mike goes through the portfolio, he'll show how, when you look at our portfolio, how you can quickly assess our views on interest rates. That's the first thing. And the second thing is the amount of corporate bonds and what type of corporate bonds that we want to add into the portfolio relative to the benchmark. And those are the 2 main levers that we're going to talk about. And today I'm going to focus my attention initially on what's going on in the macro environment and what that means for interest rates, specifically Bank of Canada, and also what's been priced in the market for corporate bonds as well. And then I'm going to touch on a few other topics in terms of why now bonds will outperform, or they have been outperforming, but will continue to outperform cash, which is very different than 18 months ago when cash was actually the asset class you really wanted to be in because of the rising interest rate environment. And then also give you insight in terms of what you can look like or how you can assess what the future returns will be when you're investing in a bond portfolio. So if we continue to the next slide. So on this chart, we have a chart of inflation. The left side is the year-over-year inflation. The right side shows inflation over the last 3 months. It does not include the data point that we just got this week. What I've been telling clients since the last time we've met, that there was a race between two competing factors for the Bank of Canada. Would the Bank of Canada be able to get inflation back towards its target, which it has, or would we go into a recession? And for 12 months ago, it was really unknown. Now, I would say what's happened is the Bank of Canada has got inflation back to its target. The next job it needs to do is actually aggressively cut rates to avoid now going into the recession. And the reason why I say that is if you look at the next slide, and I'm using here US data just because it's relevant for us, because the US Fed policy will also dictate what happens to us in Canada. So this chart is my favorite chart, but it's also a complicated chart to actually understand. So let me just walk you through how you read this chart. So each vertical line represents a point in time when the Fed was increasing rates in the US. So, for example, that first line where it says August 1980, that's when the Fed was raising rates in 1980, and the size of the line represents how much they raise rates. So, in other words, if you look at August 1980 and you go to the left, it says 600. So it means that the Fed at that time raised interest rates 600 basis points or 6%. Similarly, if you go and look all the way to the right, you can see a line that says February 1994. That's when the Fed hiked rates in 1994. And you can look, if you go to the left, it says 300. In other words, in 1994, the Fed increased rates by 3%. And then what we plotted was, let's assume all those rate hikes started when the Fed started increasing rates this time. When did we get either the recession or the economic slowdown? And what you can see that, in August 1980, we got a recession 9 months later. March 72 is about a year and a half later. All the way to the right, we never really got a recession, and we never really got a slowdown. That's many years later that we got a slowdown, so the rate hikes didn't impact it. But if you look at the blue line, that's where we are today. And if you look historically, it's still in the middle of where recessions happen. In other words, monetary policy lags, and it takes time. And now the job for the Fed in the US and the Bank of Canada is to decrease rates rapidly so we can actually have, when we plot this graph, 10 years from now, the hike of 2022 appear all the way on the right side. And for the Bank of Canada, we have a unique problem that the US Fed doesn't have. And if we go to the following page, that is our mortgage market. As we all probably are aware, in Canada, we essentially reset our mortgages every 5 years. You could go 3 years, 4 years, but on average, it's about every 5 years. In the US, that's not how their mortgage market works. You can go buy a house, and as long as you own that house, you can set that rate for 30 years. So they don't have to worry about the resetting of mortgages at higher rates. This chart below was created by the Bank of Canada, and it's trying to show and demonstrate how much mortgage rates, how much the increase in payments will happen because of mortgage resetting. So for example, in 2025, if you look at the second column, if the Bank of Canada policy rate is at 3.4% on average for the whole year, or the Bank of Canada or the 5-year rate's at 3% for the whole year, we still would expect a 26%, which is the first column, increase in mortgage payments for people renewing their mortgage. So in other words, first of all, that's a lot. That's a big increase for people. And we don't really have experience of this in Canada. We've never, outside a couple of months in 2018, we really haven't had a period of time where people who have mortgages are resetting their mortgages at higher rates. So the Bank of Canada needs to aggressively cut rates just to get to 26%, let alone get to a lower rate. And just to give you an example, in 2024, so the second row, the expected policy rate on average would have to be 3.9%. We're sitting at 4.25% right now. And the expected average 5-year rate needs to be at 3.2%, and we're sitting above that at 3.4%. So in other words, even though the market is priced in a lot of cuts, the Bank of Canada needs to cut rates dramatically still, in my opinion, so that we can avoid the pain that we've had or that we're expecting to have from mortgage increases. But also there's other signs of slowdown in the economy. On the next slide, so the next slide is trying to highlight how immigration policy has masked underlying growth. So The way you read this chart, so every quarter, every set of bars, there's going to be a blue bar, a gray bar, a red bar. The blue bar represents how much GDP increased in that quarter. So a positive bar, a bar that's up, means we're growing. A negative bar, a bar below the line, means we're overall dropping. The gray bar represents how much population growth we had in that quarter. And then the red bar represents our GDP per capita. In other words, how much are we growing for each individual that's here in the economy? And what you can see in the boxed areas, as we all know, because it's been in the press, we've had unprecedented immigration, which is represented by the gray bars, being much larger than they were in the past. And what that has done is it's actually increased the blue bars. Those blue bars are actually all positive. And part of the reason why immigration has actually increased GDP is when you are a new immigrant to any country, but let's just say Canada, you have a natural impulse of having to spend. You need to find housing, whether you buy, you rent it, lease it, whatever it is. You need to find transportation. And generally speaking, you need to buy furniture, right? Like you're probably not coming with lots of stuff from wherever you're coming from. And then generally speaking, most people immigrating to Canada are not coming from a cold country. So you think about our winters, like you need to buy winter gloves, you need to buy winter boots, you need to buy a toque, whatever it is, etc. So there's a natural impulse to spend, but that quickly diminishes afterwards. And what we're seeing, even though overall GDP is strong, on an individual basis, we're actually not doing that well. And that's the red bar, GDP per capita. If we actually measured recessions by GDP per capita versus absolute GDP, we would say we're in a recession right now. So the underlying economy, even though it looks good in aggregate, but on an individual basis, it's not great. And if you now curtail that, put that in with slowing down immigration, we could have a little problem in the economy. So the Bank of Canada, again, needs to stimulate the economy or we may be in trouble. And if we go to the following page, this is interesting. It kind of would imply that the economy is not accelerating, but maybe not as bad as it looks. And so what you have here is the Canadian unemployment rate. And as you can see, the blue line is increasing. Now, the red line underneath, think of it as being employees being terminated. And historically, they move together. But right now, the unemployment rate is actually ticking up, but the termination rate's actually staying the same. And again, this is a function of the immigration policy. Essentially, we have more people entering into the labor force that can't find jobs. So it drives up your unemployment rate, though not by the traditional way of seeing firing. And again, this is problematic. If the federal government's bringing in new immigrants and then they can't find jobs, it causes other strain on the economy. And it would imply that the Bank of Canada needs to cut rates. What I would say is I expect the Bank of Canada to cut by 50 basis points. So in other words, 0.5%. They've been cutting by 0.25% the last couple cuts at some point this year. I think even this following quarter, they could do it. The one or following meeting, which is next week. The only thing that kind of is hesitant to be really for sure about next week, they're cutting by 50 basis points, not 25 basis points, is once they cut 50 basis points, then what? Like, are they cutting 50 again? The market's going to assume they're going to be doing multiple 50s, and maybe they'll have to because of the underlying slowing in the economy. So from a rates perspective, interest rates are coming down. The economy is slowing. If you look at it from some different measures, we have this wave of mortgage resets coming on that could be problematic for the economy. And so the Bank of Canada needs to move as fast as possible, in my opinion. So What's been priced into the corporate bond market? So what this chart is showing is when we take your money and lend it to Canadian, high quality Canadian corporations, how much additional interest rate are we getting above Bank of Canada? So in other words, historically, we've gotten on average about another percent or 1.25% above the government of Canada rate. But it fluctuates up and down, as you can see. And as this goes up, it makes corporate bonds cheap. And as this goes down, it makes corporate bonds more expensive. And, right now we're kind of in a middle fair, I'd say. We're kind of at a fair value. We were much cheaper, the last time we talked. And actually, the last time we talked, we actually bought more corporate bonds and we've been selling them down as this happened. But another way of looking at this, so overall, it looks fair. Another way of looking at it is if you go to the following page, is if you are buying corporate bonds at the current level, which is a 1 to 1.25% additional interest rate above the government Canada rate, historically, what has happened? And so if you buy corporate bonds at that level, historically, the next column says the average spread increased by 21 basis points. In other words, you generally lost money. You don't actually want to own corporate bonds. And if you actually go to the second last column to the right, we've seen spread levels at this level 89 times, and only 24% of the time it's decreased. In other words, 76% of the time you lost money relative to the benchmark by owning corporate bonds. And as Mike will show you later on, we're actually overweight corporate bonds. And so why would we do that when spreads are at this level? So first, there's two reasons, or maybe they're basically the same reason. If you go to the following page, this chart is showing for different parts of the market. We are focused on in this fund is 1, 2, 3, 4, the fifth from the right, Canadian IG. It's the overall yield or interest rate you're getting by buying bonds, not just the amount additional for corporate spreads, but the government component as well. And the way you read this chart is, generally speaking, if it's on the higher level, it means all in yield or all in interest rates are much higher than they've been to their history. And what you can see in Canada at 76%, this is a very high attractive yield. So even though the corporate component might look expensive, the overall yield is attractive. And the reality is the next marginal buyer of bonds aren't just buying government bonds. They're going to buy a corporate bond fund, and they're going to have to buy corporates. And we're seeing that in flow data. If you go to the following page, if you look at flows, and again, this is US data because it's more timely and more accurate, and there's just more of it, they're showing three different markets. US corporate bond flows, which I would say is the most relevant for these two bond funds, European corporate fund flows, and emerging markets. And what you can see, in the US corporate fund flows is that there's been a big demand, as that blue line has gone up, for fixed income. And that big demand is going to be very positive for corporate bonds. And that's why it's still, even though corporate bonds individually may look expensive on one metric, when you put it all together and look at it holistically, it's still a very attractive place to invest. So I want to change gears a little bit. So, again, I said at the beginning, two ways for us to make money. One, anticipation of interest rates. I think interest rates, the Bank of Canada is going to be, well, first of all, the Bank of Canada is cutting rates. There's no question about that. It's a question of how much they're going to cut rates. And I think they're going to cut, quite a bit. I mean, and when I say that, ultimately, I think they're going to get below 3%, probably by next year. But again, we have to see, and it could be more depending on, if we get more slowness in the economy. And then corporate bonds, while they look fair value on some metrics, they look expensive on some metrics, it's a very attractive place to still invest because of the overall all-in yield. And just as a reminder, these funds are investing in essentially the best of the best in terms of Canadian corporate companies. They're the highest rated Canadian corporate companies that we're investing in. So what kind of yield can you expect, or interest rate or returns can you expect if you're investing in bonds right now? So this is not your funds. This is just the general market, and this is a general rule when you're investing in bond funds similar to the two that we have here. The best predictor of your of your performance that's going to be in the next 5 years is your starting yield. So this is the index. So as of September 30th, the index was at 3.4%, 3.47%. You know, historically, that meant you're earning, if you go down where that intersects down, around 5%. What I would say is if you're getting 3.4% in a cutting environment, you're probably going to earn 4.5 to 5.5%. It just depends on the level of cut. And you remember, this is the index. We're actually out yielding the index, so we expect to actually even earn more than that. Historically, when rates were between 3 and 4% on the index, you earned about, on average, 5% over the next 5 years. Now, again, 1 year maybe 8, the other year maybe 2, but generally speaking, you're going to get around 5% over the next 5 years historically. So that's a very attractive yield for fixed income, considering when you think about what we lived in from 2010 to 2023. The other thing I just want to briefly talk about before I pass it over to Mike, two things actually. One, cash. A lot of investors are sitting on cash on the next slide. And historically, cash underperforms bonds when the rate cutting cycle starts. And also, we've seen that already. Since June of this year, bonds have returned almost 4 or 5%. And cash has probably done 1 or 2%. And we expect that to continue. You know, going to cash is a good investment in the rate hiking cycle, but as rates come down, you want to be in bonds. It's typically an outperform. And then can we go to the heat map? And then before I pass it over to Mike, there was a question, the heat map one. Yeah, thank you. There was a question about, you know, in the market environment, how do we think bonds are going to perform? I mean, I told you longer term what I would expect given the starting yield. What this chart is trying to show you is on the top, if those corporate spreads, so the additional yield we give to corporate, additional interest rate we get by lending your money to Canadian corporates, if they widen or decrease, what would happen to performance? And then you think about the rows as being if the Bank of Canada cuts rates or raises rates. So right now, the yield as of this date is 3.44 on the index. So I think we know that the Bank of Canada is cutting rates. I mean, that's kind of happened. Some of it's already been priced in the market. And the question is, from where we are now, you know, if the Bank of Canada were to cut rates 50 basis points, we would expect them to earn, we expect the bonds to earn 7.08%. If we expect them to cut 100 basis points, it would be 10.73%. Now, remember, this may be over, you know, if they're cutting 100 basis points over a year and a half, you're earning that over a year and a half. You're not getting that every year. And so I would think, you know, we know we're in a rate cutting cycle. So the rows that are more relevant are from the, you know, below 3.44. And then it becomes what spread level. And, you know, barring a recession, you know, you could see spread level go up 50 or down 50. And so I think the most relevant, you know, kind of ranges of return that we can expect from fixed income are probably from that 10.82 box, which is just kind of kitty corner to 3.44, you know, to 10.64 box, which is kind of diagonal, you know, if spreads raise 50 basis points and we cut 150 basis points. Either way, it's an attractive time to invest in fixed income after a long period of time. I'm going to pause it there. I'm going to pass it over to Mike so he can then talk about the portfolios.
Thank you, Soami, and good morning, everyone. So just to summarize, what Soami said and try and put it in the context of your portfolios, because I think it's really important and certainly much different to what we were talking about the last time that we spoke to you about 18 months ago. And that's the fact that we are in an environment where growth is slowing, inflation is slowing, and that has translated into a major regime shift in monetary policy. We've gone from rate hikes to rate cuts. And that transition has historically been very positive for bond returns, particularly, I would say, for high credit quality bonds, like those in the two legal list portfolios. And so performance has really turned quite positive in both of these portfolios. So with that context in mind, over the next sort of 7 to 8 minutes, I'll quickly walk you through the positioning and performance for the two legal list funds that we manage, beginning with the Canadian government bond portfolio. So if we could skip ahead a page, I'd just preface by reminding you that the objective of this particular mandate, the government bond portfolio, it's really about capital preservation. And so the investments in this portfolio are very much high credit quality fixed income securities. It's mostly Canadian government and provincial bonds. And then there's a smaller allocation in this portfolio to corporate bonds, but that is limited to a maximum of 50%. And that corporate bond exposure in this portfolio is really focused on the major Canadian banks in Canada. And when it comes to the maturity, so in relation to things like interest rate risk, the focus in this portfolio is at the shorter end of the maturity spectrum. So we're generally buying bonds with a maturity of less than 5 years in this portfolio. So on this page highlights some of the main characteristics of the government bond portfolio relative to the benchmark. Now, as I'm talking through some of these characteristics, keep in mind what Soami mentioned at the outset, and that is in managing these portfolios, we're really trying to pull on two main levers to generate outperformance. One is the amount of corporate bond exposure we have relative to the benchmark. The other is how much interest rate risk or duration are we taking relative to the benchmark. So with that in mind, let's start with duration. That's in the top row of the first row, sorry, of the top table. So this figure gives you a sense of the interest rate sensitivity of the portfolio, and you'll see that at the end of September, the duration of this particular portfolio was pretty much bang on in line with the benchmark at around 2.6 years. What that essentially means is we're not taking any more or less interest rate risk relative to the benchmark. As Soami mentioned, we do view interest rates as coming down. But a lot of that is priced into the market, and so right now we're neutral as it relates to interest rate risk or duration. The next characteristic I'd highlight is the corporate exposure. That's toward the bottom end of that top table, and you can see that the corporate exposure in the portfolio at the end of Q3 that stood at 27%. As I mentioned before, we have the ability to invest up to 50%, but we're at 27%. That's come down actually from nearly 35% a year ago, and that partly has to do with what Soami talked about. Corporate bonds, when you look at them in isolation, they basically went from screening as cheap a year ago to now sort of near long-term average levels. And so as that happened, as corporate bond valuations moved higher, we reduced the amount of corporate bonds in the account. But at 27%, you could argue we're sort of at the halfway point for our allowable range. And that's because we're balancing the fact that corporate bond valuations have moved higher. But when you look at all-in yields, they're still attractive. When you look at sort of the macro backdrop, it's fairly attractive for high quality bonds. And so we're trying to balance those different environments for corporate bonds. Then the last thing that I'd point out here is the yield of the portfolio. That's in the second row. So at the end of Q3, the yield of this portfolio stood at 3.12%. And so you can see that relative to the benchmark, the portfolio is out yielding the benchmark by about 11 basis points. That higher yield is very much intentional. It's really helped to drive out performance so far this year because we've had corporate bonds that have been generally stable this year. And we feel that that yield advantage relative to the benchmark will continue to be a key driver of outperformance as we look ahead. Then the very last thing I'd mention on this page is just the credit quality breakdown. And that is in the chart at the bottom of this page. And again, you'll see that this is a very high credit quality portfolio. Over half of the portfolio is in AAA rated Government of Canada bonds. However, when you compare the portfolio to the benchmark, we do have less AAA rated bonds in the portfolio and more A-rated names. And that's really a function of the fact that we have a 27% allocation to corporate bonds, and this particular benchmark has a 0% weighting to corporate bonds. With that, let's move ahead to performance for the government bond portfolio. Yeah, on this slide, there's a few things that I'd point out here. The first thing is that, our approach to managing these portfolios is very much with a long-term discipline, a long-term focus that Darren alluded to at the beginning. And so in the bottom section of the table, I'll start there. We show the 10-year annualized return for the portfolio as well as for the benchmark and what the difference has been. And so over the last 10 years, this portfolio has returned 2.06% on an annualized basis. And that's against a benchmark return of 1.6%. And so that obviously translates into an annual outperformance of nearly 0.5%, nearly 50 basis points that the portfolio has achieved over the long term. And that's very much in line with our objective for this type of mandate. The other thing I'd point out is obviously the more recent performance. And so if you look at the top row of this table, that shows the year-to-date performance. And what I would say is it's been a very strong year, as you can see here, both from an absolute return perspective, but also from a relative to the benchmark perspective. So in absolute terms, the portfolio has returned 4.8% year to date. And that is a very strong return for this type of short duration, high credit quality portfolio. And a lot of that strong return is really coming from, as I mentioned at the outset, that shift in the Bank of Canada policy from hikes to cuts, which is a sort of a strong tailwind for bond returns. And we expect that to continue for the foreseeable future as the Bank of Canada continues to cut rates. Not only has the return been strong in absolute terms, but also in relative terms. And so the portfolio has outperformed the benchmark so far this year by 37 basis points. So a very good year. And most of that outperformance in this case is coming from that allocation we have to corporate bonds. And the performance this year has been strong, and that's on the heels of a very strong year last year, if you look at the second row as well. So moving to the other portfolio, the Canadian corporate bond portfolio. As a quick refresher, this portfolio is able to buy more corporate bonds than the previous portfolio, and buy corporate bonds across various sectors. And when it relates to duration or interest rate, this portfolio is able to go a little bit longer. But again, it's a very high credit quality portfolio, and all the bond purchases, even the corporate bonds, have to be bought at a minimum of an A rating, so very high quality. Because it's the same PM team, Soami is a co-portfolio manager on both of these portfolios. This portfolio has the same philosophy, same investment process. And so a lot of the positioning will be very similar to what we just talked about in the government bond portfolio. So let's look at some of these metrics again. So if we look at duration in the first row, again, you'll see that the duration of the portfolio is exactly pretty much in line with the benchmark, albeit in this case, the duration is a little bit longer, which has to do with a difference in the mandate for this portfolio. So duration's at 5.16 years. If we move down to the next row, the yield of this portfolio is at 3.52%. So that's slightly higher than the government bond portfolio, given our greater allocation to corporate bonds here. And again, relative to the benchmark, we have a slight yield advantage. And then if we look at the corporate exposure further down the table, the corporate exposure in this particular portfolio is at 59%. So obviously higher than the government bond portfolio. But again, we have a greater allowance for allocating to corporate bonds. Our corporate exposure has come down in the last year, just as it has in the government bond portfolio, as we're trying to balance sort of valuations against the macro backdrop. So to finish, let's go to performance of this corporate bond portfolio. And again, it's been a fairly similar experience in this portfolio relative to the government bond portfolio, except that I would just say that the returns are generally a bit higher, just given the amount of the greater amount of corporate bonds that we're able to invest in this particular portfolio, and given the slightly longer duration. And so again, if we focus first on the bottom section, shows the 10-year annualized performance for the portfolio. That's at 2.7%. Annualized over the last 10 years. That compares to 2.4% for the benchmark. And so over the long term, we are outperforming the benchmark in this case by 29 basis points. Again, very much in line with our objective. And then in a year-to-date context, again, that's in the top row. And again, this portfolio has a good year. Performance to September has been 4.9%. And again, we're outperforming the benchmark, and this is on the heels of strong returns last year, where this portfolio returned 6.8%. So very similar story, very positive story. And I would just finish it off by saying, as we look ahead, given the high credit quality nature of both of these portfolios, and the fact that monetary policy has really turned a corner, I think both portfolios are really well placed for the current environment, especially as we're talking about sort of a weak growth outlook with this potential prospect for a recession. So I'll leave it there, and happy to take any questions.
Thank you very much, Mike and team. I think that was a very helpful discussion. Now we do have a few minutes for questions and answers. There is the Q&A area for you to type your questions in, so feel free to add them in there. We have about 10 minutes for questions. We already have one out there, and I'll just summarize it. Basically, it's coming down to the fact that interest rates have already started coming down. Bond prices are already starting to react. Is it too late to deploy additional money into fixed income, or are we too late in the game? So for an incremental dollars going into fixed income, Soami, what do you think?
Yeah, so I mean, the way I interpret this question was like, are you too late for moving out of cash? And what my experience has shown me that while theoretically you can make the argument, oh, it's been priced in the market, and therefore you're not going to make that return, you've lost it. And, again, we've had a strong return since June. So some of it, it's not like you're going to get all that return. What I have typically found in a rate cutting cycle and a rate hiking cycle is the market way, I don't want to say overreacts, but it's never fully priced in. It's never enough. You always get more downside in the upside than you think if it's priced in, and more upside on the down. So I think on paper and theoretically, yeah, you can make the argument, well, you're just going to earn the excess yield. You're not going to get the excess capital appreciation. And again, that's a shorter term investment horizon, right? That's about just doing this cutting cycle. I think that what you would probably find is we'll probably have additional return. But more importantly, from a longer term perspective, is just looking at where the starting yield's at and you think about we're going to out yield that, what type of return are you going to earn long term? It's still a very attractive place. So part of this becomes your time frame. Is it you're looking at cash for the next 6 months, or you're looking at cash, over, or just outright yields over a longer time period? It's still a very attractive time after a almost 15-year period environment to invest in fixed income.
That's great. I'll just ask the same question in a different way. Soami, pretend that you're a municipal investor. You can invest your money in a high interest savings plan, a GIC, or one of our 2 bond portfolios. For an investment horizon of we'll say 2 years, what would be your top pick and why? It's really the same question, just rehashed in a different way.
I would take the corporate bond fund,
Because
mainly because in a rate cutting cycle, you want to own more duration, or in other words, you want to have bonds that have a longer term to maturity because they're more sensitive to interest rate cuts. So, when Mike went through the portfolio, one of the first rows on there was the duration of the bond fund. Another way of thinking that is, how sensitive are you to an interest rate cut? So if your duration is 2.5, it means a 1% cut in rates should give you an additional 2.5% return, theoretically. Similarly, if you look at the corporate bond fund, if you have a duration of 5.5, that same 1% cut will give you a 5.5% return. So if my investment options were those 4 things that you chose, I'm choosing the one that has the biggest sensitivity to interest rate cuts, which would be the corporate bond fund.
I think that makes sense. Thank you very much. Maybe just maybe from a different angle. The trajectory of interest rates is pretty much known, but nothing is set in stone. What happens with U.S. interest rates obviously will factor into it, the U.S. election. What happens in the Canadian economy, i.e., we're pretty much at the target inflation rate. It's possible we could well undershoot it. It's possible the Canadian economy could actually jump into a technical recession. What do you think these type of factors would, how would they change your outlook or the scenarios you've been presenting so far?
Yeah, so I think what was helpful for the Bank of Canada is actually the Fed cut rates, because one of the concerns that the Bank of Canada has to weigh is, as it tries to bring down rates to maybe stop the slowing down in the economy and help Canadians with this wave of mortgage resets that are coming on board, is the opposite impact of what it'll have on the currency. In other words, as if they're cutting rates dramatically, we should expect a weaker Canadian dollar, which actually hurts Canadians because we import a lot of things. It wouldn't lead to inflation. It may lead to a one-time price increase, but it's not going to lead to ongoing inflation, so they wouldn't be concerned that. So it's a balance. Conventional wisdom at the beginning of the year was, you cannot have a deviation more than 1% between the Fed and Canada. Historically, we've actually deviated more than 2%, and I would say, or as much as 2%, and I would say that we have a unique risk in our country that the US doesn't with this mortgage resets, that if need be, we could be larger. So I think that it's difficult for Canada to go into a recession without the US going into recession. Maybe a technical one, but not like a real recession. And I think that the Bank of Canada can cut rates aggressively still in this environment, given where that the Fed is started and maybe will continue to kind of cut rates.
That's great. Okay, we're coming up on noon. I think that's a good place to end the call. But again, thank you very much for everyone who's called in and joined us. I want to thank the team from MFS for joining us and sharing their wisdom and everyone else for joining us. And I hope everyone's got something out of this presentation. Any questions, you know where we are. Just send us an email or give us a call. We'd be glad to follow up. Thank you again.